This lecture provides a short overview of bonds just to kind of give you a landscape and an understanding of how things happen so that when we do the journal entries and issuance and those kinds of things, everything makes a little more sense. Okay, so essentially a bond issuance is a debt contract between the bond issuer, which is the firm issuing the bonds, and the bond holders, which are the entities that are purchasing the bonds. So in what ways is a bond a contract? First of all, it does specify the length of time and frequency of interest payments. It specifies the amount of interest payments. It also specifies a lump sum payment at maturity. And there can also be other covenants and restrictions that are part of the bond contract. And so all of these things collectively create a contract between the issuing firm and the bond holders. So there are three paths for bond issuances. The first one is called firm underwriting. And with firm underwriting, an investment bank purchases the bonds from the firm and then sells the bonds to the market, usually at a profit or a markup. And so this insulates the firm from some risk because the investment bank agrees to purchase the bonds, and then the investment bank then takes on the risk in issuing the bonds to the market. On the downside, usually that profit is going to mean that the firm receives or has to either pay a higher interest rate or receives lower proceeds because of the risk that the investment bank is taking. The second one is called best efforts underwriting. In that case, the investment bank facilitates the bond sale by charging a commission on the proceeds, but does not ever take ownership of the bonds. In this case, the firm is taking on more of the risk, and so usually the fee is going to be a little bit lower overall, but of course they still have to pay the investment bank a commission for facilitating the bond transaction. And then finally, there is, for some companies, the ability to do a private placement. A private placement means that the issuing firm directly sells the bond to the market. Usually that sale takes place only to a large or very few large institutions without the aid of an underwriter. This is obviously this is a cost savings for the firm, but usually only very large firms or well-known firms are able to do private placements, or if the bond issuance is for a fairly small amount of money, then they might be able to place the entire amount with a large institution.